It is so great to have you here, Dr. Eldar. I've been looking forward to it ever since you came on the schedule. It's going to be great to hear what your perspective is on the market.
Well, thank you very much for your very kind welcome, and I certainly hope that I can live up to that. You put the barrier pretty high. So here's what I'm planning to do today. I would like us to review the key market indices. Then I want to bring a couple of charts from outside, and then I will show you some stocks that I either own or watch. And after that, we'll open it to Q&A rather than monopolize the airwaves or internet waves for the whole time. I would rather hear from our participants what they want me to look at and answer their questions. Let me begin by pulling up a chart, or actually several charts. And one of my key rules in market analysis is that I always want to begin with a long-term chart and then make my strategic decision there. And from there, I want to go to a short-term chart to make my tactical decision, where to enter and where to exit. So strategic, am I a bull, am I a bear on long-term charts, and then timing on shorter-term charts. So several key indices. Let's take a look. Maybe let's start with the Dow Jones. I'll actually pull up their ETF, NDX. So what we see here, of course, a massive bull market that if I were to compress this chart, we would see how it was. It began in February of 2016, the latest installment of the bull market. And it ran until October of last year. Very severe drop, extremely severe drop. And you can see on this chart the depth of MACD histogram and the depth of force index, both at record depth. This to me is a sign that the downward pressure was so powerful, bears were so strong that they're not likely to be reversed in a single rally. So at the right edge of the screen, the Dow is rallying, but I don't think that's the end of building a bottom yet, because the bottom of this intensity is really asking to be retested. A quick look at other key indices. Let's pull up SPY, and that's, of course, the ETF of S&P. Very similar picture. You can see, if we take it more slowly from left to right, what I like to do with all my charts is I put triple ATR channels, or Keltner channels, as StockCharts call them in this program. I put triple Keltner channels on my charts. So it's normal for markets to trade within plus minus one ATR range. Plus minus 2 ATR shows some intensity. When a stock or especially an index blows outside of a 3 ATR channel, it shows an immense power, be it bullish or bearish, and those things tend to get retested. You can see how in January of exactly a year ago, in January of 2018, the S&P blew out of their triple ATR channel to the upside. There was a pullback in February, retest in April, and then a new up leg of the bull market, which could not reach the 3 ATR channel anymore. We have an ATR divergence. So what do we have here? A super powerful rally and a retest. Fast forward, we're going to this November, December of last year, and we can see that the decline was so intense that it blew to the downside of the 3 ATR channel. Right now, we're having a reaction rally. It reached between the two moving averages. I call it the value zone. So the S&P has recovered to the value zone, but that excursion outside of 3 ATR channel, those things tend to get retested. And last but not least, the Nasdaq. And before we go to the Nasdaq, let me just show you the Dow for a second, and because I will be comparing the Nasdaq and the Dow. You can see how the Dow is trading. Just look at the last 3 bars, right? And sorry, oh, that's the Nasdaq. I'm sorry. Yeah, no, yeah, that was the S&P. Alex, watch it carefully. That was the Dow. We now go to the Nasdaq. QQQ. Update. And you can see that Nasdaq is a little weaker than the Dow. When Nasdaq outperforms the Dow, it is bullish for the entire market, including the Dow. When Nasdaq underperforms the Dow, it's bearish for the entire market, including the Dow. So the Nasdaq tends to lead in those things, and Nasdaq is not being very strong. Before we go to the daily charts, I would like you to put up. I've sent you 3 charts, and I would like to put up chart number 1. So chart number 1. So this is the chart of the S&P, and at the top, within 3HR channel, and at the bottom is the new high, new low, weekly new high, new low index. So to me, the new high, new low index is the best leading indicator of the stock market. The new highs are the leaders in strength. The new lows are the leaders in weakness. And this is the best tool that I know of for identifying market bottoms. There's a signal I named when I discovered it more than a decade ago, 15 years ago. I named it a spike signal. Whenever the new high, new low index on the weekly chart hits the minus 4,000 level and then rises above that line, it gives a spike signal, which is to me the single best long-term buy signal in the stock market. It's a very rare signal. Here we're looking at the past 7 years of market history. We can see 4 signals. So it doesn't occur even every year. It occurs a few times in a decade. In order for the weekly new high, new low to go to minus 4,000, we have to have a sequence of at least 5 back-to-back days in which there are 800 more new lows than new highs. So we have to have a market in a state of pretty much total collapse or near total collapse. The weekly new high, new low drops below minus 4,000 and then recovers. So we can see on the left side of the chart, it happened during that correction in 2011, followed by a major up move. We had a very curious signal in 2016, in January, February. We had the new high, new low index drop below minus 4,000, rally, and then come back near that level, creating a bullish divergence. So the index made a lower low. The new high, new low index made a higher low. And from that, the market just erupted and kept on going for the next 2 years. Last December, just about 5-6 weeks ago, the tremendous bearishness in the stock market pushed the new high, new low index on the weekly chart below not just minus 4,000, but below minus 6,000. There was a horrendously powerful pressure of the bears. During the last week of December, I think it was on Friday, December 28th, the weekly new high, new low index closed above minus 4,000, giving a spike signal. And that was the start of this wonderful rally that the market had for the last 4 weeks. So are we out of the woods, or is it all fun and games going forward? I don't think so. I don't think so. There are 2 types of a spike signal. When a spike signal occurs singly, and it often happens in bear markets, there is a rally to the value zone, a rally to a slow-moving average. To create a real bottom of a bear market, we want to see a bullish divergence of the new high, new low index on the weekly chart, something that you can see in the middle in 2016. So the question is, are we done with building a bottom? Is this is what we had in December, the end of the bear show, and we're in the bull market again? The depths of this new high, new low index on the weekly chart suggests to me that we're likely to have a retest of the December lows, and that's where serious bottom building is likely to take place. So I'm inclined to call what we're having now a reaction rally in a bear move. And that rally has pretty much reached its target, but we will talk about that when we look at the daily charts in just a few minutes. This chart, and it's not the greatest looking chart in the world because I'm still doing it in Excel. This chart reflects my latest ongoing current research. Not yet finalized, but I've been researching this thing only since September of last year. But the early findings are very curious. As I mentioned, I consider the new high new low index the best leading indicator of the stock market. And what I began doing in September of 2018, with the help of one of my clients, one of our members of Spike Trade, I started tracking a capitalization weighted new high index. So we have, obviously when a stock like Apple or Microsoft makes a new high on their huge, enormous capitalization, it's a more meaningful event than some little cheap number making a new high or a new low. So I'm now measuring total capitalization of new highs and total capitalization of new lows, and plotting them as a green line and as a red line. And you can see that in September, there was a tremendous bearish divergence of the green lines. The market was holding near historic highs, and the cap-weighted new highs just created 3 lower tops in a row. Well, fast forward to the right edge of the screen. We're now looking at what's happening in January. The market is in the middle of a very lively rally, but the capitalization-weighted new highs are looking bad. They're looking pretty much similar to what we saw last September. So this confirms my expectation, my point of view, that what we had at the end of December was a super major low, and lows of that sort are very likely to be retested. And so that's what I am expecting in the markets today. So let's take a look at the daily charts. This is the daily chart of the S&P. What do we see here? Near the right edge of the screen, the S&P is rallying. One drive up, second drive up, and today the third drive up is happening. If you look at the MACD histogram, it's starting to sag. And if you look at the force index, which I consider extremely important, that to me is the best tool for measuring volume at the markets. And force index is really creating a massive bearish pattern on this chart. If we go from SPY to, let's say, to NDX, update, very similar pattern. Weakening MACD histogram, weakening force index. And of course, the same will happen in QQQ. So this confirms my point of view that what we had in January was a reaction rally within a massive bear move, and that bear low from December is asking to be retested. It doesn't mean that the market has to come exactly to that low. It may go a little deeper, or it may stop a little more shallow. But that's the magnet, I think, under the market, which is pulling it back. If we have a successful retest, my expectation is that the retest very likely will be successful. If that happens, then of course we can load up for the next major up move. But before that, I would be very, very careful. And now I'm very happy to take a question. Please go ahead.
All right. I think we have a couple in the room, but I just wanted to ask one question first. And that is, first of all, I tend to share your view. I think we more likely than not, we go back down to that December low. But what would indicate to you that we're not going to go back down there? I mean, is there a price point on the S&P? Is there a certain thing that you're looking at in terms of new highs, new lows? What would suggest that maybe your line of thinking that we're going to get that retest or close to that retest? When would you say, okay, I don't think we're going to get it? What would that be?
You know, Tom, I absolutely love your question. And this is the question that most people never ask. I had a fantastic older friend years ago, the man to whom my book Trading for a Living is dedicated. His name was Lou Taylor. And he had a habit of asking the question, like sort of like what you ask now. He was this very tough, very sarcastic guy. I would come to him with some brilliant idea, and he would look at me and say, "What's wrong with this picture?" And I used to think that he knew what was wrong with the picture, and then I realized it was no. It just he expected that something could be wrong with any picture. I hated that question. But after a while, this question just got so deeply under my skin that I asked this question myself. I would want to see, so to answer, so I love this question, and it's a question that most people, of course, never ask. We have a great idea, but think about alternatives. If the S&P starts going up towards its December highs, and at the same time the new highs and new lows expand, which they haven't done, that will be a sign that perhaps that's it. We dodged the bullet and we're going higher. But I would need to see a rally not only in the key indices, but also a meaningful rally in the new high, new low index. If you pull up the numbers for the new high, new lows in the 1 year look back window, I think we're having something like 50 new highs a day. There are 3,000 stocks on the New York Stock Exchange. At the peak of the market, we will have thousands of new highs. Right now, the number is 50. So if that number goes into mid-hundreds, I would say that, yep, no retest, we're going up.
Okay, thank you.
Mm-hmm.
Aaron, I know you had a couple of questions. What do you
Yeah,
have?
a lot of people actually really would like to see your chart settings to see how you get like the new high, new low index, and like your daily chart there as well, how you set up those different colored bars.
Yeah, well, I'll gladly show you the chart. And I think actually it's available in StockCharts. There is something called Elder Impulse System. I mean, that's a thing. But as far as how the charts are set up, so let me talk about it briefly. So you're looking at this chart. It's multicolored, green, blue, and red. Now, this is not done for aesthetic purposes. It's not done for visual beauty. These colors reflect the impulse system, which is one of my great inventions, I think. And it's described in all of my recent books. But what I consider my single most important book, my latest book, is called The New Trading for a Living. That system is explained there in full detail. So depending on market performance, which is very easily programmable and is programmed into StockCharts, go get it. If you click on, you see below where my cursor is circling, chart attributes, type, Elder Impulse System. You have it here. Now I have seen multiple lazy bums who look at something like this and they say green means buy, red means sell, blue means take a break and carry money to the bank. No, that's not how it works. The impulse system is not a trading system. It is a censorship system. How about that? Censorship system. In the stock market or in futures markets too, you can do any stupid thing. As long as you have money in your account, nobody will stop you. You need to have some control, self-control, external control. So this provides external control. When the impulse system is green, it means that shorting is not allowed. When the impulse system is red, it means buying is not allowed. And the signal is given not by color, but by the disappearance of color. Blue is neutral. So, for example, look at December. The market is going down, and of course, all the bargain hunters are buying, buy. Well, I'm sitting on my hands. The index blows out of the channel. The next bar back inside the channel is blue. Now I'm allowed to buy. So this is the impulse system. The next indicator is a MACD histogram and the MACD lines, also done very well in StockCharts. Force index, where is it? Force index should really be a 13 bar, not a 2 bar. It's at the bottom. Thank you. So let me 13 and update. Again, beautiful bullish divergence at the bottom, and it's starting to get a little weaker, but not so little weaker now at the right edge. Force index, and then at the bottom you can see I put my Keltner channels as overlays. So Keltner channels are parallel to the slow moving average, and they're at 1, 2, and 3 ATRs away. And then you play with transparency settings so that you don't want them very, very loud, cluttering the chart. So I set my transparency at 50%, at 70%, stuff like that. So that's the chart for you.
Let's see. A couple of people asked, that chart 2 that you showed, the graphic. They were wondering if you could elaborate on what it looked like back in the 2000, the end of the bear market in 2008, 2009, or during it.
Basically, what happened there was a massive bullish divergence there. There was a series. In 2008, there were 3 spike signals, and each of those signals sent S&Ps back to the value line, back to the value zone, the zone between fast and slow moving averages. The bottom of the new high and low index occurred in October of 2008. Then there was a more shallow bottom in December, and in March of 2009, there was a bottom in new high and low, in the weekly new high and low, which completed a bullish divergence. It was within 1 week. It was during the week in which the bear market hit its low. That signal really hit the nail on the head, and that's it. After that, there was a bull market, and the next buy signal occurred in 2011, which I showed you earlier today, and in 2016, and then we had a signal last December. I mean, these are super powerful things. This is the single best long-term buy signal that I'm aware of. Happens a few times in a decade. We had this signal in December, so the $64,000 question now is, are we in a bear market? And this was just the first bear market rally that we're experiencing now, or was it the type of a decline that's going to be retested and establish a bullish divergence, and now a new major up move is likely to start? I don't know. I don't have a crystal ball. I cannot forecast the future, but I can watch those things every single day, and I can read the divergence when I see one.
Yeah, absolutely. Let's see. The last one I think I'm going to ask you here is, so the breadth thrust that was signaled on January 9th, was it a signal that the bottom of the market is reached?
I don't do breadth thrust. So by January 9th, I was heavily long, and because all my signals came in, the spike signal occurred in December 28th. Then a lesser signal called spike bounce signal, which is given by a daily new high and low chart, occurred the next Monday. I was up for the races. So by January 9, it was just a confirmation. But you have to, my sense is, to be a successful trader, you have to anticipate things. You cannot be trading what you see on the screen today. You have to always ask yourself, what's next? What's next? What's next? What's the pattern? And of course, you never know for sure. But after looking at thousands and tens and hundreds of thousands of charts, you eventually develop an eye for what's happening. And so that's why this chart on the screen today. Let me switch it to the S&P. SPY update. You look at a chart like that, and you see. To me, it looks like the index is hitting its head on the ceiling. Go higher, go higher, go higher. Of course, today nothing much is happening because there will be a Fed announcement at 2 o'clock. So yes, things are more quiet. But that's it. You know what? Let me show you. Since you like fundamentals, I'm not a fundamental analyst, but I respect fundamentals and I pay attention to them. Let me show you one fundamental indicator at which I glance everything. I have my morning homework. Every morning I go through, I have a spreadsheet and I go through a procedure. Line A, line B, line C, takes me maybe 10, 15 minutes to go through everything, but it sort of gets me in gear with what's happening. I do the same homework every single morning. So let me show you one fundamental number which is alarming. This is one of the best leading indicators of world economy, not of the stock market, of world economy. And the indicator is Baltic Dry Index. It has nothing to do with the Baltic Sea. Simply the exchange where it's traded is located on Baltic Street in London. And this index, which interestingly enough cannot be traded. There's no trading vehicle based on that. So there are no games around it. What you see is the real true index without any arbitrage. This index reflects the cost of oceanic shipping of dry goods. Now, most of world commerce moves by ocean. Now, if you order an iPhone, it may arrive by plane flying out of Hong Kong or Shenzhen. But most of world commerce, the absolute great majority of world commerce, is done by boat because it's the cheapest mode of shipping. For example, if you're shipping a container, let's say from London to 50 miles of inland on the east coast of the United States, the cost of shipping that container across the Atlantic is cheaper than moving it by truck 50 miles inland, right? So that's why everything goes by boat. And so when you track this index, Baltic Dry, it shows you the cost of shipping. And by the way, someone asked a few minutes ago about the signs of the 2008 bear market. In 2007, Baltic Dry Index, the world economy was standing on its tail. Baltic Dry reached a level of 10,000. By the end of 2007, before the bear market began, it dropped from 10,000 to 1,000. Now, there was a signal. So what do we see here? This is, unfortunately, I can only pull up this indicator for 5 years. If somebody knows how I can get it for more than 5, by all means, let me know. But at the bottom, and unfortunately, the date line is cut. So the very bottom in the center of the screen, that was 2016. And you can see how the world, the health of the world economy bottomed in 2016 and went up and away. It topped out around October, and now it's been falling for the last few weeks very sharply. Baltic Dry is at 797. To find when it was last time at 797, you have to go back to 2017. It already blew out the 2018 low. So this is not a happy sign. It better shape up and start going up now quick, because if it doesn't do it, it's a bad portent for world economy. Now, it can change, but the way it looks at the right edge of the screen is certainly flashing a bright yellow light. Caution, caution, caution.
Awesome.
Those attention flags.
It's always a pleasure to have you on here, Dr. Elder. We really
Thank you very much. Thank you.
So in the book itself, just so everybody knows, it's all StockCharts charts. It's all StockCharts setups, but I talk about why to use candlestick charts, why you might want to use line charts, bar charts, mountain charts like you'd see on the business news networks and those kind of channels. A lot of it is about the settings in StockCharts and how to make great charts. This is actually a book about building your base, understanding how to make the chart display the information you want, all of the little trick settings. I think it came out pretty well. So in the book, what I try to do is show how to get things set up, specifically about overlays and indicators, how to turn them on, how to change the settings, how to make them show up the way you want them to. And so if you're struggling with any of the sort of chart settings, that's an important part. With that, thanks everybody.